Hi everyone, Milad Reza here. In today's video, we're going to talk about your superannuation and what not to do when the market fluctuates, when it's on the way down, and the sort of mistakes that most people make, not understanding this really fundamental key aspect of super and that are units and unit price. So we're going to get into that really in depth today. And once you get this, you won't touch your super when the market drops just because you feel like it. You'll just leave it because you understand how things work, and makes a pretty big difference. Now, there's a difference between, reacting when the market drops and there's a real reason behind it. Like let's just say the property market, offices after COVID, the demand was lower, versus a tweet from Elon Musk or Donald Trump impacted the markets and you panic. End of the day, you got to understand that those businesses that you're invested in inside your super, they're no less valuable because of some political noise. So you got to really make that sort of difference there. Is it a long-term change in the sense of, after COVID with offices, or am I just panicking because everyone else is panicking? So that's really important to know. Irregardless of all of that, what you really need to understand is how all this works inside your super. Just because you've lost, say, $50,000 or $20,000 on paper after a big crash doesn't mean your superannuation is less valuable as a whole. It may be that the unit prices have dropped, and we're going to talk about that today, but you ultimately have the same amount of units. So to make this a lot more easy to understand, I'll just go through some notes here for you so you can get all of this down pack and you won't make the mistakes that most people make. All right, so as an example, let's say inside your super, the way it works, you got what are called units. You own a certain amount of units, and each unit has a unit price. Now, in a regular market, let's say each unit is worth $10, but then the market drops and each unit then becomes $5. But as a whole, if you've got 1,000 units and the market goes from $10 to $5, you still got 1,000 units. Make sense? You still got 1,000 units. All that's happened is you've gone from $10,000 of total super balance, $10 at 1,000, versus after the collapse. So you've gone from $10,000 to now say $5,000. But that's just a drop in the unit price. Nothing to do with actually you holding less units, because ultimately you still got 1,000 units. Now, let's say you, like most people, make a big mistake and move everything into cash after the market drops. You are solidifying the market at the $5 mark. You're basically solidifying your losses. And that would be then what we call a timing. So you're trying to time the market to say, well, I've gone out of the market at $5. I reckon I can get back in at a certain amount. And once you start doing these sort of things and trying to time the market, it's where it pretty much all goes wrong. Historically, it's been proven if you miss out on 10, 20, 30 good days over a good period, say 20, 25 years, your returns are quite diminished. You're talking 1/3, 1/4, half of returns on what you should have got when you are investing in sort of like an index or not. So it's not just the 25 years, it's getting those 10, 20, 30 really good days, making sure that you're still invested. So trying to do this sort of thing, you can really shoot yourself in the foot. And you don't even really need to do it, because again, if you've got $1,000, you still hold the same amount of houses, as an example. Just because the house price has dropped doesn't mean you're going to make all these fancy decisions and make some changes. And what I always say to people is, and this has been a saying in the share in the investment world, is, if you owned a farm, every day someone wouldn't come to you and say, would you want to sell? Do you want to sell? Do you want to sell the farm? You wouldn't make that decision on a daily basis. Why is it that people make that decision when it comes to the share market? If you've got a portion ownership of really good businesses, like, as an example, BHP or ANZ or Commonwealth Bank and so on across the globe, Alphabet or Amazon, if you've got part ownership, why are you making a decision on a daily basis whether you should sell them? It doesn't even make sense. That's just, you might as well go down to the TAB and put some bets down. You're not going to get it right. No one can predict the future. So if you think that you can predict, or if your advisor or if your guru hedge fund manager is telling you they can predict the future, they wouldn't even be doing that job in the first place. Because if they could, they'd be lying down on a tropical island somewhere and enjoying themselves. But all that stuff, no one can predict the future. Ideally, you just want to be invested for the long term. So you don't really need to even do this sort of thing. But what's even more beneficial is if you think about it, all right, you've gone from an environment where those unit prices were $10, now they're $5. And what happens with most people's super funds is they've got these contributions coming through, correct? So they have employer contributions coming through. And as an example, if you've got $6,000 of contributions coming through for the year, or $10,000 of contributions coming through for the year, at the moment the super guarantee is 12%. So your employer should be putting in 12% of your salary into your super. That $10,000 of contributions, if the unit prices have gone from $10 to $5, what are they doing? They're buying a hell of a lot more. They're buying double more units as before. So as an example, if the drop didn't happen, you may have ended up on, say, 1,300 units. But because of the drop, now you got 1,600 units, if that makes sense. Because of the drop of the unit prices, there's a sale on, and your employee contributions is buying more and more units. So in a way, for accumulators, it's kind of a good thing if the market drops temporarily, because your contributions are buying more and more units. And when the market recovers, which it always does, it has historically shown it's this sort of trend. It's not going the other way over a long period of time. You own more units, which means that you actually have gained more in terms of super. So when you start thinking about it like that, you don't just make these silly decisions of, I'm going to go into cash and then try to time and I believe next year there's going to be this event, so I'm going to make this decision to pull some money out and do this. You can't get it right. No one's got it right. Don't try to time it. And if you think that you can do that as a side hustle, and you really think that you can sort of time these things, or your advisor's telling you that they can time these things, it's nonsense. No one can do it. And historically, like I said, if you miss out on 10, 20, 30 good days of trade because of those silly decisions, not only do you cost yourself big returns long term, but you're also causing yourself a lot of headaches and stress, unnecessary stress. So unless there's a real compelling reason, like I said, with COVID, that was a pretty big thing. So that whether those offices are going to be full again, that was a real key thing to consider. But the share market's forever going up and down, and you're just not going to be able to avoid that. So once you start thinking of separating those things, like I said, you got the units, and then you got the unit price. And this is forever going to go up and down, but as long as you've got the same amount of units, or if you keep building up, then you're in a pretty good position. You really need to understand this for accumulators. But once you get to the pension phase of your super and you start taking money out of your super, that's when it's quite important to have the strategies in place and understand your advisor really needs to be on top of it, so you avoid what I call sequential risk. Sequential risk, which means having to sell when the market's down. Now, the reason why you have to sell when the market's down in retirement, when the market's down, is because you need to get money out of your super. And the only way you can get money out of your super is by selling your units in the traditional super funds. And if they're trading at, say, $5 versus the $10 before because of a crash, then you're basically having to sell twice as many units to get the same amount of money out, if that makes sense. You have to sell twice as many units to get the same money out. So this is the portion in retirement where drops in market are quite important. And if you've got the right advice, if you've got the right advisor, they would have done some good work to make sure that when you do hit retirement, you're not exposed to sequential risk, having to sell when the market's down. You've done some work leading up to your retirement days, and you've got the right super setup, right structure of super that allows you to also do some strategies with cash flow, so that when the market does drop, you don't have to sell too many units or no units at all. You basically take the money out from the cash portion of your super. And that's only available in a very specific sort of structure of super. And this is really the only part of your super days where you need to have those strategies into place. But for accumulators, like I said, if the market drops, there's a sale on, you're just going to accumulate more units unless there's a compelling reason and the asset class is no longer going to rebound. As an example, if you're invested in a company that is no longer a viable company because of technology advancements, then obviously it's never going to rebound. But when you're talking about super, you're invested in a lot of different shares, so chances of your super not rebounding is quite low. So if you're someone that needs a bit more understanding about these units, the unit prices, if you're thinking what sort of superstructures are out there and what does this part of it mean, if you're getting closer to, say, age 55, you do need to start to do some planning with your advisor. You need to understand different structures of super. And the more you can sort of shelter, the more you can create a buffer for your units and preserve them, the better off you'll be in the long run for your super. Because once you start selling these units, they're gone forever and they can't produce for you anymore. No more returns, no more income, and that's it. And that's where people get caught out in retirement, and that's why they go back to work, because they've sold off the units cheap because they didn't have the right planning. And in the traditional super funds, in the retail world or in the industry world, it doesn't matter. You can't do much planning around this. You're exposed to sequential risk. That's why it's important to have a good chat with an advisor that understands this. And so you can create some buffers. So when the market drops, you don't just sell off the farm and go back to work because you just sold off all your units cheap to get your drawdowns of, say, $60,000, $70,000 a year to basically live off because you didn't have the right plans in place. So I hope that sort of clarifies and sort of gives you a bit of an idea of why you shouldn't make such drastic decisions in the accumulation phase. But equally important, you should have a good chat with an advisor that knows and understands units and unit prices and cash flow management so that you can start creating some buffers when you get closer to your retirement